Thank you for joining this webinar from Yellowstone Advisory. Today's company presenting is IMI plc, who released their full results on the 3rd of March. And with us today are Luke Grant, Head of Investor Relations and Group Financial Controller, and Edward Hann, Investor Relations Analyst. I'd now like to hand over to Luke Grant to start the presentation.
Hi, good afternoon, everyone. Thanks, Alex. And yeah, as a quick introduction, so I'm Luke Grant, Group Financial Controller for IMI plc, and yeah, also looked after investor relations for the last year. I've been here for 10 years, and yeah, looking forward to just giving an introduction to the business, and then also we'll give an overview of 2022 results as well. So if you think about IMI plc, so we're roughly a 2 billion revenue company. We have sites all over the world, and our main focus is in valve applications, so sort of technologies that open and close to control the motion control or also fluid control. I think, as it says at the top, it's a purpose-led strategy that's really focused around acute customer problems for ourselves. So we're really looking for very niche applications in the harshest environments, or to very, very fine degrees of accuracy across all the different businesses that we operate in, which we'll come on to shortly. And how we define our purpose is it's all around breakthrough engineering for a better world. And what we really mean is whether it be reducing carbon emissions, making things more efficient, making things more comfortable, safer, more productive, and that, I think, unifies our employees and how we go out to market in terms of dealing with our customers. I think the purpose was launched in November 2019 with the Roy Twite starting as CEO. And I think over the last few years, we've seen sort of employee engagement increase year on year. It was another record year for employee engagement last year. And I think a lot of it comes back to the culture that's driven around having the purpose, breakthrough engineering for a better world, and how well that resonates either with existing employees or when we're out in the market, and then what we're then doing for customers. And in terms of the three ways in which we think about how we're creating value as a business, customer satisfaction is key to us. Because we are trying to be a niche player, we have to have great customer satisfaction, great customer service in order for our customers to want to order through us and not go, maybe for a cheaper or easier specification, let's say. I think key around also operating in niche markets is around having the best and most innovative products that are led by our customers' needs. So whether or not that's, we'll look at sort of valves that shut off at kind of over minus 200 degrees C, others that can operate to the accuracy of a micron, so that our products are very, very sticky in the market. I think the other thing is IMI has built up over a number of years, including we've done 4 acquisitions in the last 18 months, which means there's an inherent level of complexity. And over the last 3 years, and we've probably still got about another 2 years left on our complexity reduction program, which is really supporting margin improvement over the last few years. And it makes us easier to deal with for our customers as well. And in terms of the markets we operate in, so we are split into 3 different divisions. And I think all the markets we're operating in, I think, have clear sort of macro trend drivers. So industrial automation, so IMI Precision Engineering, the division at the top, is about half of the group, and the 3 key markets it operates in. So industrial automation, products that would support things like, we have a rice sorting machine, for example, where we have a valve that opens and closes to get rid of dirty grains of rice when you're bagging rice, just as an example of a product that would go into that market. Life sciences, for us, it's a lot of it's around valves that control dosing into different analytical products and devices, selling to some of the really large life sciences customers all around the world. And transportation products would go into mainly heavy duty trucks on things like braking systems and thermal management as examples. Critical engineering, which is roughly a third of the group, it's largely an energy business, so selling across all energy markets in the world. You'll see I've got some products over my shoulder, but I haven't got any critical products because a lot of those would be about the size of this room or even larger. They'd weigh several tons. So that end of the market is really sort of large scale. And then hydronic engineering, the third division, it's really an indoor climate business. So in your house, we would sell little thermostatic radiator valves, or I don't know if anyone on the call has Heat Miser, which is the thermostat company that we recently purchased, a UK brand. Or we also do lots of the control technology in buildings like the one I'm sat in, where you have lots of different control valves to operate the flow of water around the building to heat it and cool it efficiently. And then just looking a little bit into the detail of the three divisions. So yeah, as we said, precision, I sort of see as sort of the mid-sized products, motion, fluid control, where precision, speed, and reliability is essential. Just sort of gone through the key markets, and I think in terms of financial performance, that division for 2022, so we're roughly a £2 billion group. Precision, half of the business is just shy of £1 billion. And I think you can see that the margins across all the divisions are relatively similar, with 18.5% for precision. So a good drop through on the sales for that division. Critical, a lot of it's around steam, gas, liquid control, definitely in really harsh environments. Big power plants, for example. So key markets being power, oil and gas, refining, petrochemical. And then, I said roughly critical's about a third of the group, and the margins in 2022 were 19%. And then hydronic, really a heating and cooling business. It's the smallest division with revenues of 350 million, so a little bit less than 20%, but has the highest margins, really supported by very strong brands across particularly our continental European business, with a brand like Hann being really well regarded. I think what this gives us across the divisions is really good resilience through, if you look at our results over the last 3 years, clearly a lot happened with the pandemic, the Russia-Ukraine war, supply chain crisis, and so on. And we've been very resilient in terms of our performance through that period. And our outlook for 2023 is positive as well. So just trying to give a little bit of a flavor then of different products we have and the different scales of the different products. So the FAS flat prop, now we sold, I think it was over £100 million of these during the pandemic. So we were actually one of the key suppliers selling valve components, one of the key products that goes into the ICU ventilators. That you'll have seen there was a big sort of drive to get more of those during the pandemic. And this valve is accurate to about the width of your hair. So it's really small components that go into it, accurate to roughly a micron. And what it does is it controls the flow of air and oxygen in a ventilator to allow you the time to sort of breathe and hopefully fight off any virus or disease you have. And then if we look at critical engineering, so I said much larger scale valves operating in much severe temperatures. The example here, this one will operate to minus 196 degrees. We do even do products that control the flow of liquid hydrogen, which is more like, I think it's minus 253 degrees, maybe something along those lines. So we do a huge range of harsh environment products within critical. You're mainly serving the energy market. This one for LNG, so liquefied natural gases. And then within hydronic, we're continuing to evolve our product range to have more smart connectivity. I think particularly hydronic, selling valves into buildings that controls the flow of sort of hot water around the building for, say, heating or cooling. I think the need for data in that space to understand how efficient your setup has meant we've launched the TA Smart, which is a valve with an actuator on top, which can effectively measure the flow of water through a device. And then you can, someone who owns a building can use that data to set up their building much more efficient. And the beauty of our products is we're about 3% of the cost of the system, but we can save about 20 to 30% of the cost of the the whole setup when you include sort of the boiler and everything else you need for a heating setup. A big part of our growth strategy has been around using something that we call the Growth Hub. So it's using very quick 12-week programs, looking at potential products that we can sell. We've got a huge product range within IMI. There's so many different applications we can sell into. And that's what's really started to build momentum. We sort of went from 0 Growth Hub orders a couple of years ago to, I think it was 52 million we delivered in 2022. So kind of over 2% of the orders of the group. And it sort of continues to increase year on year. I won't dwell too much on each of these examples, but for hydrogen refueling stations, we've gone from selling basically 0 2 years ago to now having 3 million orders. So it's a little valve that helps control the flow of fuel in a hydrogen refueling station, which is clearly a high growth area for us. In critical engineering, 17 million orders with a Aerosolve is the brand name, which is a large valve which reduces steam erosion in power plants and maximizes customer uptime, meaning they need to have less maintenance windows, which is better for their profitability. And then finally, we're also, I think part of the growth of IMI is driven by regulatory evolution. And a good example of that is in Germany, where all municipal building owners are required to heat their buildings now to a maximum of 19 degrees C. And we were able to design a thermostatic radiator valve, which effectively locks radiators in those buildings at 19 degrees C and can be retrofitted across all radiators in Germany. The 4 million of orders literally just in the last quarter of this year. I then alluded to the fact that acquisitions is a reasonable part of our strategy. So we've done 4 acquisitions, which you can see just below the headers. So Adaptas, Core Solutions, Bar and Heatmiser, all in the last 18 months. And they're all moving IMI into faster growing markets. And they're all, I would say, acquisitions primarily driven by sort of commercial growth. So not sort of cost saving acquisitions. They're more around us cross-selling our existing products or expanding the geography within which we sell. I think the Adaptas acquisition was the largest one, which is one of the leaders in mass spectrometry, which is an analytical device which can maybe analyze up to, say, 240 pathogens within your body to see if you have any potential risk of illness in years to come. So, quite an exciting development in that field. And Core Solutions, excuse me, is another technology around that area. I think Bar just expands our product range. We mainly do pneumatic actuation, which would be actuators that move backwards and forwards that are primarily controlled by air. What Bar does is expands us out into electric actuation, which is actuation controlled by electricity, of course, but and it gives us an ability to go to our customer base agnostic of whether we use pneumatic or electric actuation. Electric actuation is a faster growing market, so it's quite an exciting one for us. So some of you on the call may have heard of Heatmiser. Our most recent acquisition closed just before the close of the year. I think perceived to be the UK's leader in smart thermostatic controls. It's currently principally a UK business, but our hydronic business is principally a continental European business. And I think there's an opportunity for us to use our strong brands within Europe to scale that business across at least Europe, and then sort of we'll take a look at thereafter. Brilliant. Yeah, I will pass on to Ed.
Thanks very much, Luke. So I'm now going to provide a quick overview of our capital allocation principles. So to start with, we look to maintain a very disciplined approach to capital deployment. And given the diversity and resilience of our business, we target a net debt to EBITDA position of between 1 and 2 times. Now, our leverage at the end of 2022 was 1.8 times, and the cash generative nature of our business means that we probably would expect this to reduce by about half a turn during 2023, unless, of course, we're successful with additional acquisitions to accelerate performance. Capital investment continues to be an important driver of sustainable, profitable growth, and we really focus on opportunities that align to the better world purpose that Luke alluded to earlier, and expect to continue to spend at a level above depreciation going forwards. OPEX is equally important, and R&D expenditure now exceeding 3% of sales in 2022. And on acquisitions, we will continue to pursue those that help us move further into the attractive markets like Luke just talked through, but we will always execute them within our strict financial return guidance. We must deliver IMI's cost of capital by year 3, and they must not be materially dilutive to the group's overall ROIC by year 5. We maintain a progressive dividend policy, and some of you may be aware that we increased our proposed final dividend by 10% at the year end. And finally, we manage our debt position to minimise both the interest rate and the liquidity risk, maintaining around 75% of our debt at fixed rates, which are currently fixed at about 3%. And we've spread the maturity of this debt over 6 years, starting in 2025. So if we can move on to the next slide, please, Luke. We also wanted to take this opportunity to give a quick update on our ESG progress and provide an overview of our new sustainability framework, Creating a Better World. So this framework's only just been launched, and it sets out the most important priorities for our business, and it's been developed in collaboration with a range of stakeholders who are part of an ESG materiality assessment that we concluded last year. There are 3 pillars to this framework. So firstly, empowering people. We develop and empower people to make an impact and create a better world. And we've made great progress here in the year, with employee engagement now at record levels and our recordable accident rate improving by 38%. We're also making excellent progress on gender diversity and are benefiting from the strong female representation on our exec committee and board. So secondly, sustainable solutions. We will engineer solutions for our customers that are safer and more sustainable. And every day our people are helping to improve the energy efficiency in buildings, improve analytical devices to save lives, and reduce emissions in both oil and gas and also in trucks. And thirdly, climate action. We will play our part to address climate change by minimising the environmental impact across everything that we do. And again, we continue to see great progress in reducing our CO2 intensity, with a 9% reduction last year and a 25% reduction since 2019. We're committed to a net zero target for Scope 1 and Scope 2 emissions by 2040, and recently announced a target to be net zero for Scope 3 by 2050. So if we can move on to the next slide, please, Luke. Now, this slide here shows how our strategy is delivering sustainable improvements in our financial KPIs since it was launched back in 2019. So you can see that revenue's been growing at 3% CAGR, and our adjusted operating margin is at 360 basis points at 17.8%. Adjusted profit before tax has been growing double digits at an 11% CAGR, and return on invested capital has improved by 130 basis points to 12.7%. And finally, adjusted EPS has increased from 73.2 pence back in 2019 to 105.5 pence in 2022. So before handing back to Luke, I'd just like to provide a quick update on the investment case. So firstly, as you've seen, our purpose-led strategy is delivering improved margins and sustainable profitable growth. And our Better World purpose aligns the group to attractive growth markets that are supported by global macro trends. Now, Luke ran through the divisions, and we have a well-balanced portfolio that's bound by world-class engineering capabilities that offers through-cycle resilience. We have a strong balance sheet that offers strategic flexibility alongside disciplined financial objectives and targets, and we have a differentiated environmental profile. Our solutions enable energy efficiency, sustainability, and safety. So with that, I'll hand back over to Luke.
Thanks, Ed. And yeah, as mentioned, we'll sort of a bit of an introduction of IMI, and now we'll have a look at 2022 results for a 31st December year-end company. So we released these to the market a couple of weeks ago. So yeah, I think after two good years since the strategy was launched in November 29, I think third year, another good year for us. So your revenue growth 10%, of which 4% was organic, and yeah. I think the price volume split, which I know is always quite interesting for people, was roughly most of that 4%. I would say sort of mid-single digit was price, so volume sort of fairly flat. But bearing in mind, roughly 2% of our business was sold into Russia, which of course we exited following Russia's invasion of Ukraine. At 15% adjusted earnings per share growth, so I think really nice profitability on the incremental revenue we got. And then as we look ahead into 2023, I think they're very resilient order book to end the year. It was up 14% for the group, with critical engineering up 18%, which is the larger scale valves we do, so the longest order book we have. So it's the best sort of future looking reference for that division. I mentioned before, Growth Hub, sort of the innovation engine for the business. I think orders last year about sort of 24 million and sort of more than doubled this year up to 52 million, with continuing opportunities across each division. It was 3 acquisitions in the last year, 4 in the last 18 months, as Adaptas was closed sort of December 2021. I think particularly in a high inflationary environment last year, I think we're really happy with the way in which you know, we managed inflation through our supply chain, and also you know, it's demonstrable because we operate in these niche markets that we have, you know, I would say, you know, reasonable ability to put price through, and therefore adjusted operating margin of 80 basis points, and we managed to do that, increase margins in every division. We talked about some of the underpins to the improvement in the financials. I think record employee engagement scores, improved health and safety, very important. And also, as a company that is trying to deliver excellent customer service, the best thing we can look to is our customer satisfaction scores, which are industry leading across every division. And importantly, strong results gave us the confidence to propose a final dividend of 17.4 pence per share, which is an increase of 10% year over year. I won't spend too long on this slide, but this just gives you a sort of a feel for the breakdown of the growth of each division. You'll see adjusted growth for Precision's higher than the other divisions because of the impact of the acquisition. So Adaptas and Bar both sit within the Precision division. So a lot of that additional growth is driven by acquisitions, and same on the profitability side of things. I think maybe yeah, we managed to increase our operating cash flow 6% year over year, which reflected a 80% cash conversion, which I think given the sort of supply chains, we were holding a bit of extra inventory to supply to our customers, and we'll take a look at that going forward. Cool. And then just looking at sort of the strategy since it's launched in November 2019. So if we sort of take 2019 as a base year, bearing in mind, of course, 2020, 2021, quite challenging for, you know, lots of companies given sort of the impact of COVID, supply chains, and then of course Russia, Ukraine impacting us -2% as well in 2022. Yeah, I think feel like we've demonstrated good resiliency through that, and continued to improve profits year on year for the last 3 years. And also you can just see there's a really nice trajectory of the margin year over year as we kind of deliver a little bit more growth than we have done in the past, and B, the benefits of the complexity reduction program come through to the bottom line. And so we have a margin target at the group level to get to 20% margins. You know, we started this strategy at 14.2, improved margins 360 basis points to 17.8% over the last few years. And you know, we included this slide in our year-end results presentation just to show that clear trajectory of how we see ourselves getting to the 20% target. We put very clear complexity reduction savings out in our announcement, which I'll come on to in a couple of slides time. So we've got 42 million of restructuring benefits, and principally on a £2 billion business that will increase margins by 2%. So that alone will broadly get us to that 20% target. But we're also focusing on growing the aftermarket and our critical business faster, and the gross margins in that business are higher than the new construction element, and we've been growing that business at about an 8% CAGR, so quite a nice rate over the last few years. So we expect to see a bit of margin improvement from that, and then finally just growing the business partly through acquisitions, but with higher margins, but partly also just a lot of the growth of orders that come through a higher gross margin than our existing business. Yeah, and then just looking at the detail of the profit and loss, this starts at our adjusted operating profit, which is up sort of nicely year on year. And then our interest expense increased year on year from 12 to 19 million, and that's as a result of the acquisition. So we funded the acquisitions through debt, which increased the cost of our debt. Our profit before tax is up 13%. And then in terms of how we deliver the complexity reduction program, so we have restructuring costs associated with those. They were a little bit lower than they were in 2021, as there was a sort of a major part of the project was delivered in 2021, with the benefits then accruing into the 2022 profit and loss, but there were still some ongoing elements in 2022. The acquired intangible amortization is as a result of the acquisitions we delivered, so most of that increment is due to the Adaptas acquisition, and then the exit from Russia cost us about £9 million. But overall, what we're sort of looking for is if we increase adjusted operating profits, also we would want to see the statutory measures increasing at a similar rate, and they grew sort of 15% year over year. Good to see. And I mentioned the complexity reduction delivering benefits. So what we've done for the first time is split out the final leg of the complexity reduction program. You can see it's done in hydronic. The kind of future restructuring charge is zero. But in precision and critical, there's a little bit of a way to go there. So you've got some reasonable sized projects ongoing in precision this year, and critical before we expect to sort of see it significantly tail off from 2025 and onwards. But the thing we're always keen to demonstrate, which we feel we have done through the margin improvement of the business over the last few years, is that the benefits of this program are dropping through to the bottom line, and we're giving the returns back to shareholders of the investment we're putting in on the program. So 20 million of restructuring benefits to accrue in 2020. And most of those projects, they're basically complete by the end of this quarter. So it's just a case of the benefits accruing. So feel quite confident in delivering those this year. And then we'll sort of kicking off the projects heading into 2024 and 2025, in the coming months. A little bit on cash flows. So I think we said at the sort of the bottom line a couple of slides ago, the overall adjusted operating cash flow is up 6% year on year, and that represents a cash conversion at 80%. But you'll see over the last 2 years, with supply chains being as they are, there's been quite a significant investment, principally, I would say, in inventory, which are the two negative lines in the middle of the cash flow you see here. And that's to make sure that we can deliver great service to our customers. Plus, we've also held some extra inventory as a result of some of the complexity reduction programs we've been doing, where they involve footprint consolidation. So we're expecting, particularly in our precision and hydronic divisions, that are slightly what we call shorter cycle businesses, so they just turn over a little bit faster than critical engineering. We would expect to see inventory reducing through 2023 for those businesses. Critical is more of a function, the inventory we hold is more of a function of the order book, and as the order book's up significantly, we would continue to expect to hold a little bit more inventory within critical. But we've said our cash conversion expectations will be sort of 90% plus for 2023, so expect to see a bit of an increase on the last 2 years, which have both been sort of above 80 but below 90. Good. So I'll cap off with just sort of key messages. So I think 3 years in for the sort of launching the Breakthrough Engine for a Better World strategy, and continue to deliver results through 2020, 2021 and 2022, delivered 4% organic revenue growth in the year, and then 15% adjusted EPS growth off the back of that, with it was a 13% CAGR on adjusted earnings per share over the last 3 years. Heading into 2023, the order book's up in all divisions, so sort of good momentum heading into this year. And the Growth Hub, which is our sort of engine to really deliver incremental growth for the group, delivered 52 million orders in 2022, and continue to expect momentum in that area. 4 acquisitions completed in the last 18 months, which are in faster growing markets than our existing markets, so going to help support accelerating growth for the business. Really nice progressive dividend policy, with the final dividend up 10%. And then our outlook for the 2023, bearing in mind our earnings per share were 105.5p for this year, is that based on current market conditions, we expect 2023 full year adjusted earnings per share to be around 111%. And I think there's an overarching statement: we remain confident delivering the sustainable, profitable growth and a 20% group operating margin through the cycle over time. Very good. That's all from me. Thank you everyone for listening, and we will head over into Q&A.
Brilliant. Thank you, Luke, and thank you, Edward, for that introduction and showing a number of factors why IMI is a high quality company. We're now going to go to questions, and just as a reminder, there's a chat box at the bottom of your screen, and if you do like to ask a question, please type it in there and we'll try and cover as many questions as we can. We've got the first one here, which is, what is the ideal level of debt and what does that mean for the scale of acquisitions that you can make?
Yeah, that's interesting. So when Ed presented, he mentioned around our net debt to adjusted EBITDA being 1.8 times. And we as IMI would probably look to operate within the net debt to EBITDA range of 1 to 2 times. So we're sort of towards the upper end of the range, bearing in mind we've done sort of 4 acquisitions in the last 18 months. We will try and operate within those bands. So, but as Ed mentioned, we will probably reduce it by about half a times during the year, down to 1.3 times. So sort of through a year, we'll generate free cash flow that allows us to potentially acquire more companies. So, we feel pretty good about our acquisition pipeline. But these things are quite opportunistic in terms of the timing. It's very difficult to predict when an acquisition will or won't happen. So I wouldn't put any sort of timelines on sort of a next acquisition. I don't think any company ever would, really, right? But it gives us firepower, perhaps as we head into the second half, if we wanted to do more. And we would probably look for a similar scale and size as Adaptas, Bar, Heatmiser, sort of in that sort of purchase price of sort of 50 to 200 million pounds, let's say, roughly.
Okay, we've got 2 more sort of linked questions on acquisitions, and the first one is, can you say a few words about how new acquisitions are integrated into the group and managed?
Yeah, of course. So I think it's a very, very important process for us. I think Adaptas would be a really good example. So I think and that's the largest acquisition we've done recently. So I think the main focus in the short term is on the commercial integration process. So it's really about getting our, if let's say there's a synergy process on the commercial side of things, which most of our acquisitions would be. So it's about training the IMI's existing sales force to understand the new acquisitions products in order for us to accelerate those through their markets. Now, Adaptas, as an example, has a very strong position in the US market. We sell sort of not into the mass spectrometry space in Europe, but we do have lots of major life science customers within Europe. So there's a clear opportunity, mainly for us, I think, to sell Adaptas' products into Europe, but also some of our existing products like the ventilator product that I talked about earlier, and how we would sell that across into the US. I think that there is also sort of like the back office integration process. I think that is a focus for us. There are some sort of non-negotiables, like things like IT security being on the sort of whatever the group policy is for that. But I think other processes that we have at IMI, it's about sort of steadily integrating those and not overwhelming the acquiring company. I think, there's obviously a lot to take in when you're owned by any listed group in any country, relative to what a lot of the time would be sort of a family-owned business that we're taking on. So we just sort of edge that up over time.
And as I said, there's a second question on acquisitions, and it's, IMI's recent acquisition of Adaptas takes you into offering design and assembly / integration of fluid control devices serving the life sciences space. How have customers, so some of the instrument makers, received IMI's entry into this segment? And do they now see IMI as a competitor? And how does IMI address this concern with customers and strategic alliance partners?
Yeah, I think everyone's really, really excited to see IMI move into this space. And I think, the sorts of things we're seeing is customers sending us their analytical device to our manufacturing facility and saying, look, we currently have this valve and it's not operating at this flow. Can you go away and design a valve with your engineering expertise, which is allowing us to, I sort of think of it in terms of pounds per product on each analytical instrument. It's the same as we sell into trucks or into the industrial. You think about how can we get more of our equipment into the existing customers we sell into. It's the fastest, easiest way to grow, much easier than trying to win new customers, let's say. So I think that's been really, really well received. I think that the technology we have in Europe, there's a clear synergy play out in the US, and I think the technology Adapters has out in the US, there's a clear synergy play within Europe. So I think the evolution of that will be quite exciting to see over the coming years. Of course, life sciences, it takes a few years to get onto a platform. You don't just do it overnight because of all the approval levels and things in sort of medical health industries. I think in terms of your question about, are there any concerns from sort of customers, I think with where we're positioned in the supply chain, given we're not making the entire machine, we're still a component supplier into the machine. I think we only just add more value to our existing customers or new ones, rather than it cause any sort of competition type issues.
Okay, thank you. Got a question here on margins. I think you covered some of this, but asking for a bit more detail. Is the operating margin target 20%? Is that achieved through making progress in all divisions or improving margins in precision engineering and critical engineering?
Yes, it's an interesting question. So I think we would look to improve margins across all divisions. So we have margin targets of sort of broadly 20% across all the divisions. Hydronics already at the 20% level. But some of the sort of recent developments in that business mean that we would expect margin to increase again. And if you think about it, to get to, because we have about 1% of costs for the corporate center that we split out, implicitly all divisions have to be sort of above that 20% level to get to an overall 20% group margin. So yeah, I think all divisions should be 20% or above.
Okay, thank you. How difficult is it to recruit staff with the right skills, and what is wage inflation running at across your business?
Yeah, I think wage inflation, I would say circa 5% for 2023. I think we segmented it down into, I think employees on lower salaries or in higher inflation territories got a much bigger increase than 5%. I think more senior employees in lower inflation territories or even higher inflation territories took a smaller percentage increase. So we sort of weighted it based on seniority in the group. And in terms of difficulty in hiring staff, I guess we're a global company operating in a lot of different markets, and therefore at any one time, I probably would say that there might be some challenges. Sometimes we have a factory where sort of, I don't know, a 220,000 square meter Amazon warehouse opens up next door, and you might see a bit more attrition than we would in a short space of time. But generally, I think we have sort of good benefits, pay reasonably well, all that sort of stuff. So I think we do a lot of work to retain employees, and I wouldn't say we've had any significant issues of any note in sort of the recruitment side of things. But I think it's just something you just got to constantly keep on top of.
Yeah, thank you. Going back now to the acquisitions, when you go to the market, are you seeing multiples come down, and how much interest is there from private equity?
Yeah, I think in terms of our acquisition pipelines, I think the nature of the acquisitions we're going for are more family-owned businesses that we're looking for, and I think therefore a lot of it comes down to just time frames. So I think we will only move as fast as the kind of the owner of that company is. And would I say it's having a dramatic impact on multiples as we sit today? I'd say probably not in the immediate short term, but a lot of, I think let's see how it goes as we sort of go through the year. I guess interest rates are only really started to increase, the last few months or so, and you would ultimately expect that to sort of slightly dampen multiples in the medium term, definitely. But as I said, M&A is opportunistic, and the processes we are in tend to be slower, let's say. So because we just want to sort of work with the family. I think of all 4 acquisitions we've done, the previous owners have stayed with the company. So I think that's an important part. The relationship building is an important part of the process for us in terms of how we do our acquisitions. Yeah,
thank you. And just as a reminder to people, if you do want to ask a question, please type it into the chat box at the bottom of your page. We've certainly got time for a couple more questions. So if you do have some burning question you want to ask, please do so now. We've had another one that's coming on acquisitions. What level of acquisitive growth do you target on top of your 4% organic growth every year?
Yeah, so I think because of the nature of M&A being acquisitive, we don't tend to target have a specific strategy that says we need X of M&A. You know, you could very quickly get into a position where you feel forced to sort of buy something over and above, you know, what you know, coming back to sort of how our multiples moving, what you should pay for things. So I think we're always out in the market, you know, looking for M&A, but I don't. It's something that would accelerate our growth, but it's not a precursor to the strategy.
Okay, thank you. Are there any areas of the business which are heavily volume driven and highly competitive?
Yeah, I think our most competitive space that we operate in would be the transportation space within precision engineering. So that's slightly less than 10% of the group. So you've got, if you think about that space, we've got a very consolidated customer base that we sell into, particularly if we're selling into the truck producer. You know, there's only so many major truck producers in the world, and they are major companies themselves. So I think, you know, they have leverage over a company, you know, companies that they operate with, and they work on, you know, very high volumes. So if you think about the volumes of some of the products we do for critical, the volumes are just one. You know, I think I was in Germany a few weeks ago, seeing an 88-ton valve where they had to sort of, you know, close the town overnight and stuff got shipped out of the factory. That's very different to what you see in commercial vehicles where you know, truck volumes would be tens of thousands. And it's, for us, it's about how we can, and why we play in that market is because it's very high quality, very you know, I think sort of even compared to life sciences, the truck market, you know, safety and braking, that sort of stuff just needs to be incredibly high quality. So yeah, but we definitely see a little bit more competition, higher volumes in that part of our business relative to the rest.
Okay, thank you. And we've got one last question, which is coming here. Can you talk about the products you have for the hydrogen market and how you see that market developing over the coming years?
Yeah, so I think hydrogen for us, we probably have about 6 different applications we sell into across the divisions. And if I think precision engineering, we talked about orders won for hydrogen refueling at refueling stations, principally, I would say, for heavy duty trucks. I think, you know, the weight of a battery needed to power a heavy duty truck, you know, means we see it reasonably likely that hydrogen fuel cell trucks will be more likely than, say, obviously battery powered cars are, you know, definitely moving on the sort of commercial car space that you know, everyone on this call would drive. But I think we definitely see an opportunity in fueling stations for hydrogen. I also think on hydrogen trucks, the actual sort of some of the sort of products that we sell into our existing sort of diesel truck manufacturers, for example. You know, we're already on a pilot in China of 3,000 trucks and buses, sort of testing some of our products there. So as we look out over the next sort of decade or so, we see that as a good growth avenue. I think within critical, we're already selling products into hydrogen storage. We have a hydrogen electrolyzer product, and also there are a few other different routes. Liquid hydrogen storage in China as well. I think the cryogenic valve that we talked about that could store things at minus 190 odd degrees. There's also an equivalent for storage of liquid hydrogen, and hydrogen being an incredibly difficult molecule to store in liquid form. So, you know, it's definitely something that plays well into our business. I think we've therefore got quite a few different bets across hydrogen. I think, you know, orders last year roughly about £8-9 million, something like that. So, you know, not getting carried away with it yet, but I think as we go through the medium term, you know, we have growth targets out there for hydrogen, you know, much more significant. Just to close out on hydronic and hydrogen, because if you have a hydrogen boiler, a heat pump, a gas-powered boiler, we then power the circuit around that. So we're actually agnostic of the technology that sort of creates the heat, if you like. We just control the flow of the heat around the building.
Okay, thank you. We've had one more question come in, and I think we've got time to take it, so I'll ask it here. How does IMI view the electric actuation space in the future? So can you talk a little bit about the competitive landscape, growth in electric versus pneumatic and hydraulic?
Yeah, definitely. So I think I mean, clearly we've just acquired Bar, so we think positively about the electric actuation space going into the medium and long term. I think pneumatic will still continue to grow. So I think just generally across sort of industrial automation, where a lot of those products go into, there's a lot of demand for automating production processes, particularly. It's becoming hard, and you asked the sort of the question earlier, Alex. It's getting harder and harder to get people, and therefore it's requiring companies to do more and more, automate more and more processes, and therefore having a product portfolio both in pneumatic and electric gives us the opportunity to deliver both to different customers. I would say electric's probably the slightly faster growing part of the market. And that's part of the reason why we've acquired into that space, to expand our product range, but we definitely still see lots of growth opportunities for pneumatic. Part of the reason why there's lots of opportunities for pneumatic is it's a lot cheaper than electric actuation, but there are certain processes, in fact, pharmacy automation, life sciences, where, for example, you've got clean rooms, and it's nice to have sort of quiet machinery working in the background, whereas pneumatic actuation would be a little bit of a louder process, let's say. So depending on the area we're selling into will depend on our sort of go-to-market strategy on sort of pneumatic versus electric. But yeah, definitely both great markets.
Brilliant, thank you. That brings us to the end of today's webinar. Luke and Edward, thank you very much for the introduction to IMI and going through the FY22 results, which was an incredibly strong performance. So thank you for telling us all about that. Appreciate everyone attending and asking questions. As you leave today, you'll come to a feedback form. It'd be really appreciated if you could complete that feedback form. And just to flag up a couple of webinars that we've got coming up next week on the 28th of March, we've actually got a webinar at 12:30 with Kenmare, and then at 5 o'clock with Lloyds Banking Group. And then into May, we've got a webinar coming up with Sainsbury's. So thank you again for attending. Please complete those feedback forms when you leave, and we hope to see you all soon. Thank you.